Welcome back. Today we're going to do our first class example for revenue, and we're going to talk about the discounting of revenue and do some journals. Please make sure you got a pen and paper ready. You got to do this with me, guys. Okay, so A entered into a sales agreement with C on the 1st of January 2012. Terms of the agreement were as follows. Full legal title to the goods would be transferred to C on the 1st of January. That will be the contract date. Okay, and in terms of our risks and rewards, that is the dates that the risks and rewards will be transferred. But there's one little trick here. The sales price would only be settled by a once-off payment of $855,000. Remember, I'm using CU. It could be dollars, rands, whatever, currency units. But it's only going to be transferred on the 30th of September 2012. That is 9 months later. Okay, and now this 855, please take note, I've included a sales tax, a VAT, of 14% in that 855 contract price. So remember here, let's look at the rest of the company A's normal sales. Well, A's sales are normally COD, cash on delivery, and we now know that we need to apply some type of discount rate because there is no interest being charged. So if there's no interest being charged, well, then you need to do some discounting in terms of IAS 18. So what rate would I use? Well, I would say that a before tax discount rate for a similar instrument of an issuer with a similar credit rating is 12% per annum compounded monthly. So I'm going to have this as 1% per month. Okay, the 12 over 12 months. The reporting date is 30th of June. So let's start off now. Let's do our first journal at the 1st of January 2012. Okay, we're going to have to recognize revenue at the present value of the amount due to the company A. Okay, so let's just go through the total thought process here. I do want to recognize debtors, right? Debtors will also need to, or trade receivables, will need to be recognized at the present value of the future cash payments. But there's going to be two components to this debtor. There's going to be the gross debtor or gross receivable, and that is a financial position account. That is going to be the full 855. Yes, I haven't present valued it yet. Okay. If I wanted to work out the present value, I'll do a quick calculation. I'll just do it at the bottom here. We'll call it working 1. I would take my future value of 855, put it into my financial calculator. I would then have N, the number of periods being 9. The interest being applicable is 12% over 12 months being 1% per month. The payments, well, there aren't any payments here. No interest, only one final lump sum of 855. So therefore, compute the present value, and that will give me 781, 761. So what am I going to do? My unearned finance income, okay, we'll call this also a receivable. But a negative receivable called an unearned finance income. Also a financial position account. It reduces the debtor, please, ladies and gentlemen. Those two are together. Okay, so do the maths quickly. The 855 minus the 781, 761. Which we've got at the bottom here. 855,000 minus the 781, 761. That is going to give me a figure of 73,239. See, I'm only recognizing the net amount as the debtor, right? So the net amount will be 781,761. I have to show it on 2 line items to create an order trail though, please. Okay, what's next? Well, I've got sales tax, right? We call that value added tax. And that is also a financial position account. Remember, revenue, only income that is received on your own behalf, the gross benefits. So that will be based on the contract amount, 855, inclusive of this VAT or sales tax. So I'm going to go 14 over 114. And that will give me a VAT that I owe this amount to the tax authority of 105,000. Okay, that is not revenue from my account. That is money received by my company A on behalf of the tax authority. I will need to pay that across. Okay, then my balancing figure will be revenue, and that will be revenue from the sale of goods into profit or loss. Balancing figure, which is the present value minus the VAT amount, of 676,761. Remember, I'm not using the 781, the net receivable, because I needed to take off the actual VAT amount. And the tax authority does not allow you to present value that. Okay, so that's the first day journal, nice and easy. Remember, all the different components have to be treated separately. The interest will be separate from the sale of goods. So what happens now? At my reporting date, I'm going to have to recognize the interest income now. Because what have I done? I've had my little timeline. My present value was the 781, 761. 9 months later, it's going to go all the way up to 855. But remember, 9 months is September. My reporting date is the end of June, which, ladies and gentlemen, is 6 months later. Okay? Apologies there. 6 months later. Okay, so to work out what is that balance after 6 months, I will do the first calculation. I will take my present value was 781, 761. N this time is not 9 months, it is 6 months. I is still 1% per month. Okay. Payment 0, I'm now going to compute future value. And the future value is going to be 829. 855. Please take a second, do that on your calculator. Make sure you can work these financial calculators of yours, whether using a Sharp, a Casio, a Texas Instruments. It is important that you can use your financial calculator. Excel on your computer also does great functions for these type of workings. So I'm going to take my future value of 829 less the present value, which was 781, 761. And that leaves me with a figure of 48,094. So what's the difference between the present value and the future value of 829,855? Well, it must be interest, and that is going to equal 48,094 up until June, 6 months later, please. Okay, so now I need to go and credit revenue or possibly other income with interest in profit or loss. 48,094. The question is, where does the debit go to? Well, if you remember in our previous example here, I had this little negative debtors account or negative receivables account called unearned finance income. So I'm going to take the debit to receivables and that account will be called unearned finance income. I'm abbreviating. U is for unearned, FI is for finance income. So that makes my debtor bigger by the 48,094. Okay. After a couple of months, we'll get up to having the debtor to equal 855, and then we will go debit bank, credit the trade receivable. With the full 855 in the new financial year. But that's not what we asked for. I only asked up to 30th of June 2012. Okay, so that is an indication of how we unwind interest and show the different components. Component 1 was interest. We couldn't recognize interest on day 1 because we hadn't earned it yet. It went to unearned finance income, a financial position account. The other component of revenue was revenue from sale of goods. The 761, and that happened on day 1 when the risks and rewards were transferred. As time moved on, the interest was unwound and we earned the interest income and recognized 48,094 on the time apportioned basis up to the reporting date of June. That went to revenue in P&L. Thank you so much.